Welcome to Bruegel. I'm Nicolas Véran, Senior Fellow here, also at the Peterson Institute, and it's my pleasure to open the session, which is devoted to the work of the Financial Stability Board on so-called too big to fail reforms, rather reforms to end too big to fail, not to promote too big to fail. And of course, the prompt for this session is a report, a consultation report that the Financial Stability Board, the FSB, has published on June 28, which is a kind of evaluation after a few years of those so-called too big to fail reforms. So it's my delight to welcome for this discussion Claudia Buch. She's well known to this audience as Deputy President of the Bundesbank, a position that she's had since 2014. She has a very distinguished academic career. She worked in Kiel for the Institute of the World Economy in the universities of Tübingen, Magdeburg, at the Institute for Economic Research in Halle, IWH, and she's been the leader of this Financial Stability Board work on too big to fail reform. So she will present the report and also the process of the consultation. And to discuss that, we also have, we're very grateful to have Alexandre Biry of S&P Global, as it's now called, formerly known as Standard & Poor's. I should, of course, mention here that we're also grateful at Bruegel for S&P's financial support of Bruegel, which is a public matter. Alexandre has been at S&P Global since, I think, 2009. Before that, he was in the financial industry at UBS, at Fitch, and he's now Global Head of Banking Analytics and Research for S&P Global, which means really the kind of global guru for all things banking in terms of analysis, and too big to fail, of course, being very relevant to ratings, because if banks are too big to fail, they should be very good credit. And actually, there is a section on the opinion of the rating agencies on the reforms in the report itself. So that's probably enough from me by way of introduction. I suggest we first hear from Claudia on the report itself, and then from Alexandre, and after that, it will be the usual free for all. Those of you who are familiar with our platform, you know that questions are to be asked on the Slido platform, sli.do. There's a code to enter, so hashtag TBTF, quite simply, capital letters, small cast, no matter. And once you're on the page of Slido, you can ask questions, and I will filter them and relay them as to the best of my ability to the participants. So now, floor is you, Claudia. We want to hear about the report. And please share your screen so that we can see your slides.
Yes, thank you very much, Nicolas. Thank you very much for Bruegel for having me here. I'm not sure what the here means, because we're all in different places, but here in this virtual room. So let me share my screen, because I just want to show you a few slides from the a few graphs, data from the consultation report that has now been published. I apologize up front if you hear background noise. There's construction work going on right outside my window, so maybe this makes you hopeful that the German economy is back on track, but it might interrupt us here a little bit or disturb us a little bit. I hope not too much. Yeah, so like Nicolas said, really what I'm talking about here is not my own work. So I try to steer the work as good as I could, but it's really the joint effort of a large group of very knowledgeable people from the FSB membership. So this was open for all FSB members to contribute to this working group. The group started early last year with this evaluation of too big to fail reforms. We had academic advisors, so maybe we in the discussion can also talk a bit more about the evaluation process. Yeah, want to focus on the content. This group has now prepared a report, which is actually also heavily based on previous evidence, both from official institutions, from academia, from the private sector. So for those who are interested, who are still lacking reading for the summer vacation, there's a long also technical appendix, which is all the details. So what did we do? As you know, the too big to fail reforms really have the objective to mitigate moral hazard, systemic risk in the financial system, to put into place framework also for the resolution of financial institutions, something we didn't really have prior to the crisis. So there's a very novel element in here in terms of institutional design. And the banks that we're looking at here, the global systemically important banks and the domestically systemically important banks have to have higher capital requirements, so the G-SIB surcharges, and they're also subject to enhanced supervision. So there's a whole package of reforms, and I should say that we focus only, quote unquote, on the too big to fail reforms. Of course, a lot of other things happened, which is also making identification of effects, of course, a bit more difficult. One of the problems I think that we're all facing when we want to evaluate the effects of policies is that the core objectives, namely moral hazard, systemic risk, these are things we can't observe. So we need indicators, we need to look at mechanisms, and this slide summarizes the mechanisms we've been looking at. So we've focused a lot on bank behavior. So we've looked at banks' balance sheet, what do they do, how are they capitalized, and how do these choices affect systemic risk. That then obviously has implications for the probability of crisis, the capital shortfall in a crisis, things we also try to estimate. All this then has implications for the choices of government. So if there's high systemic risk, if an adverse shock hits, then banks may fail or may be close to failure. So governments have to choose whether they want to bail them out. That was very often the choice taken in the financial crisis, or whether there's instruments, tools, sufficient bail-in capital to make bail-in and resolution feasible. That then has implications for markets, so how they perceive the likelihood of government support, which leads to an implicit funding.
It seems we are losing you, Claudia. Let's wait a bit, but we're not hearing you anymore.
Effects that reach beyond borders and the macroeconomic.
Claudia, sorry for interrupting, but we lost you for about 20 seconds.
Oh, okay. Am I back now?
Yes, you're back.
Oh, okay. Sorry, I didn't notice. I thought I actually had a stable connection. So feel free to interrupt me again. So I'm not sure how much you can see the chart here. I was just trying to explain the interaction between what banks, governments, markets are doing, but I'll come back to it as I go through the presentation. Okay, so what are our key findings? And obviously, as I said, there's a lot of evidence here in this report from previous literature, from what we did. And these are just really key headlines summarizing it. So the first is that actually the indicators of systemic risk and moral hazard that we've been looking at are moving into the right direction. We also see that effective too big to fail reforms bring net benefits to society. This is something that we're stressing here because obviously we need to look at it not from the individual bank's perspective, which is also a valid perspective, but not for I think the regulators and the public authorities. So there are net benefits for society, but we also see that there are still gaps that need to be addressed, and I'll be more explicit about this in a second. So starting with these indicators that we've looked at, what you see here, first of all, is that the capital ratios of globally systemically important banks have increased. This is tier 1 relative to risk-weighted assets, so weighted assets of financial institutions. And you see that I try to pick up, because we are in Europe and with Bruegel, I try to pick up the European results a bit. So you see here, Europe is largely in line also with the rest of the world, North America. When we look at leverage ratios, then Europe also has seen, or European banks have seen, an increase in capitalization, but that kind of levered off a little bit in more recent years. So here the progress is less pronounced than in other regions. We've also looked at how this has affected lending of banks, and the big picture is that lending has not really declined overall. What is interesting to see is that if you look at the left-hand side of this panel, that both domestically and globally systemically important banks have somewhat reduced their market shares and other banks have increased. So we don't see an overall decline in credit, but we see a reallocation of market shares, which is perhaps something you would expect. That decline in market shares of the G-SIBs is a little bit less pronounced again in Europe. That's what you see on the left-hand side. So this is a bit what has happened with the banks. I'm sure we'll come back to some of the details. What the group has done as well, and I think this is interesting both for policy and also for researchers, is to compile new evidence on resolution reform. So there's a resolution reform index that we have constructed. Here you see the overall increase in implementation of resolution policies. You also see distinctions between the home and host countries of G-SIBs. So the home jurisdictions have done more, probably because also felt the need was more pressing. And a lot obviously has also happened in Europe. So these are the results broken down by country in Europe. And of course, that has a lot to do with the implementation also of the BRRD, the Bank Recovery and Resolution Directive. So there has been significant progress in terms of feasibility of resolution. What we also wanted to see is how about credibility of markets, and I'm sure that Alexandra has a lot of to say about this. So what is the assessment of market participants on the credibility of resolution reforms? We've looked at a lot of previous evidence. We found that previous evidence is somewhat patchy because most of the studies that have been done on funding cost advantages of systemically important banks were for jurisdictions like the US, and where there was a lot of data. Also, academia at some point stopped looking at the issue. So we updated those studies a bit, and what you see here is just a snapshot of the analysis that we did, but I think it's quite intuitive, and it's also representing a lot what others have found. So what you see here is that funding cost advantages of large systemically important financial institutions relative to comparable institutions. Of course, that's hard. What's a comparable institution? So we looked at non-bank financials, we looked at large non-financials, and these funding cost advantages, which is kind of a proxy of the implicit funding subsidy that I talked about at the beginning, these funding cost advantages have fallen. Oops. Can you still hear me? Because my computer just told me that the connection is unstable again. Am I still with you?
Actually, I can hear you very well. I didn't experience problems.
Okay. So it was just a computer. I was a little bit overly cautious. So the funding cost advantages have declined after the reforms. Whether or not it's causal, hard to say, but at least it's a very clear pattern. But they're still not as still at a level not that different from the pre-crisis period. So that's also something that needs to be borne in mind. And what's interesting is that the funding cost advantages have fallen more the more effective or the more decisive has been the implementation of resolution reform. So there's a correlation, and also the estimates of funding cost advantages we have are more linked to the risk of the institution. So there's progress there in terms of credibility that we can also see and measure in the data. Is it beneficial to society? A big question, and I just have one chart where we try to visualize a bit what we've looked at. Obviously, we've looked at all the potential social cost, bank lending, GDP, cost of funding, and we've looked at the potential social benefits. And without going into much further detail, we find that there's positive net social benefits. I'm happy to give more background on this, because this is certainly a very short summary of the rich evidence we have. How about the gaps? So what did we find? Obviously, this is a very new system, in particular the resolution reforms, new institutions, new legal frameworks, and we are, so to say, learning how the new system is working. So one of the things we found is that there's still many obstacles to resolution that can be reduced. I leave the details again for the discussion. Information can be improved. So there were a few things where we found it hard to get good information. I must say, though, that on one of the issues where there's a lot of information gaps internationally, which is the holders of bail-inable debt or TLAC, Europe actually has a good data infrastructure. So maybe that's also something to stress in this discussion. And we felt that monitoring can be enhanced with regard to the domestic systemically important banks. And also, as we've seen before, some of the activity has shifted to non-bank financials. It may also be that the risks have shifted, so that needs to be monitored. So with that, I would like to close and again emphasize that we need feedback in this conversation today, but also from the audience, and reach out to others who can't join us today. And there's basically three things that we are interested in, which is, are we drawing the right inference? So we looked at a lot of evidence and we're drawing some conclusions. Are we doing this in a sufficiently balanced way? Are we missing anything? Are there other studies? And is there scope for updating what we have done now that we're in the COVID environment? I should say that all the empirical analysis has been finished prior to the pandemic. How to provide feedback? All the information is on the FSB website, and there's also an hopefully easy to remember email address at the FSB, which is fsb@fsb.org. And by the end of September, feedback can come in, which can also be informal, but submitted through the website so that we get a good feedback from the audience. Thanks a lot.
Very nice summer activity for our audience, and I immediately give the floor to Alexandre. I have tons of questions, but first let's hear from you what to think about it all. Alexandre.
Sure. Thanks, Nicolas, and thanks, Bruegel, for the invitation, and also thanks, Claudia and colleagues for this consultation. I mean, there's a lot of excellent analysis in that, so I confess I probably need a bit more time with my teams to look into some of the details, but yeah, excellent research there. And I'll probably start with the conclusion is that actually we do agree with the essence of the reports, and we do think that over the past 5 years, the FSB has put in place a generally credible framework to tackle too big to fail. And maybe one way to demonstrate that is to look at our ratings, and our ratings do show that we believe in this framework. If I step back, how we construct bank ratings, the main ratings typically is what we call the ICR for issuer credit rating. That's the level at which we rate the traditional senior unsecured debt. Because we have to be very accurate now with the terms when we talk of the different debt types, but the ICR. And this issuer credit rating is typically constructed from, we start from what we call the standalone assessment of a bank, i.e. what's its creditworthiness, excluding any consideration of support. And on top of that, until 2015, we're typically, in some cases, adding some uplift for support. It could be for expectation of government support, or for instance, for subsidiary, expectation of group support. In response to the too big to fail reforms, what did we do? Well, in early 2015, we first removed any government support uplift from the ratings on the holding companies of US or European banks. And then later in the year as well, and I'll have a couple of slides to show you that, we removed, or we changed our assessment of the supportiveness of a number of countries in Europe and also the US. We moved it from what we used to call supportive to support uncertain. And in parallel to that, we assessed the resolution regimes in US and Europe to be what we would call effective, and therefore started actually, and that was probably quite a forward-looking assessment, because obviously 2015, still early days, but we saw that there was a credible path, a credible framework, and credible intent as well from the jurisdictions in Europe, for instance, to put in place those frameworks. So we took this assessment, and also reflecting the existing bailing buffers, but also our expectations of the build-up. In many cases, we replaced the notches of government support by notches of something we call ALAC, it's basically TLAC, but on soup, on version of TLAC, to reflect the fact that we did think that for the traditional senior unsecured bondholders, there were potentially some benefits from these cushions of more subordinated liabilities. And that does mean that actually—
And sorry to interrupt, Alexandre, yeah. I have to exercise my duties as the acronym police. TLAC, of course, is a total loss absorbing capacity that is defined by the Financial Stability Board's standard.
Good point. Thanks, Nicola, and don't hesitate to interrupt. Rating agencies, we tend to have like so many acronyms as well. So, but that doesn't mean that in the end, with all these actions in 2015, there were only a handful of downgrades of operating companies. And that shows that we did expect that over time, there'd be almost a substitution or transfer of the distribution of losses in case of crisis between the taxpayer or the government towards more the holders of those subordinated instruments. So, so if we fast forward, and I've just got a couple of slides, I'll be super quick, I promise, so that we can go more in the interactive sections. Let me see if my technical skills are good enough. Can you see my slide here? Yep. So, so if you fast forward 5 years, I mean, this is actually, we did that in April 2019. I was a bit in a rush, so, but I think the data here are still correct. So you can see on this chart 2 dimensions according to which we look at support and too big to fail. The first dimension is our assessment of government propensity to support, and you can see we have 3 categories. So if you're uncertain in our ratings, we can't factor in any government support uplift, but supportive and highly supportive, depending on the sovereign rating, we can include notches of government support. The second dimension is what we call ALAC. So as I said, it's additional loss absorbing capacity. It's our framework to look at the potential uplift for those bail-inable instruments, and we assess all these systems according to how effective this resolution framework is in those countries. That's a precondition for us to potentially include uplift for those cushion of subordinated liabilities. And you can see on this map, without going into too much details, the journey that some of these jurisdictions have gone through. And in Europe, as I said, so you can see bottom left-hand side, as in the US, we don't factor in any government support, but in some cases we can include ALAC support. And we've seen recently Hong Kong or Canada still staying in the supportive bucket, for instance, but with more effective resolution regimes, which shows that here in this case, we're still actually reflecting government support, but we think there could be some optionality in some cases. And then some jurisdictions, for instance, in top right-hand side, where we still often reflect government support, and we don't think that the resolution regimes is truly effective yet. And maybe the last slide for me is just, as well, I think we need to be cognizant that jurisdictions can be complying with the FSB objectives around too big to fail, but with different with a different agenda themselves. And you can see on this arrow really, that's our own assessment of the ambitions of these different jurisdictions, going from Singapore, right-hand side towards countries like the US or New Zealand, where we think that there is really the agenda to prevent any bailouts, and in between shades of gray in terms of the optionality of bailout being still potential on the cards if needed under a certain scenario. And then we can see this lovely map of Europe where for some countries, for instance, dark blue countries where just resolution is effective, and we include some uplift for those bail-inable instruments, or countries in yellow where, for instance, the framework is also effective, but we may not yet include uplift. And that could be for a variety of reasons. Sometimes the sovereign rating level can act as a ceiling. But I'll probably stop there in the interest of time, but just to show that with these slides that we do think that there's been real progress, but progress does vary. And the objectives sometimes of the jurisdictions themselves vary, but there is overall a credible framework that's been put in place on this multi-year journey, really. I'll stop sharing now and hand over back to you, Nicola.
Thanks so much to both of you also for keeping the time discipline. We have some time now, a bit more than half an hour for questions. We already have a number of questions on the Slido platform, so I repeat, slide.do is our platform for asking questions. The code is #TBTF, lowercase, capital, whatever you prefer. I'll start with a question of my own. You have a category Alexandre at S&P, which is euphemistically called support uncertain. So you don't really have a category where you say there's not going to be any support at all in any case. And there's a fascinating annex in the report, which is Annex G of the FSB report, page 124 to 126, where the FSB is listing cases of bank failures in recent years all around the world. They are typically not GSIBs, but some of them are pretty large. And what we see is that, too big to fail is alive and well. Most of these cases have involved what a common person would call a bailout. So here's my question to both of you. The reforms are titled Ending Too Big to Fail, but is there any prospect of that, or is it kind of an aspiration that will remain just that, an aspiration and something we can be closer or farther from, but never really attain? Starting with you, Claudia, you need to unmute yourself.
Yes, thank you. That's obviously, I'm not even sure whether it's the elephant in the room, but it's the key question that we all have to ask ourselves. So I think actually this ending too big to fail for my taste is a bit too black and white. So that means like you had too big to fail to begin with, and then you end it, and then you have it never again. But I think what we've heard from Alexandre and what we also see in the evidence that this is a process, and I think what we've learned and from the crisis is that what's the framework we need to have in place, what's the loss absorbing capacity, how do we have to empower institutions. So this has been a big project, and I think these lessons have been learned, so we know what needs to be in place. Now we're putting this into practice. We have these new frameworks, and we're learning how they're working, like I said before. So and obviously whenever you create something new, there's also gaps and there's things that can be improved. So I think in that sense we have learned how to end it in terms of what do we need, and we also now see where things are not perfect yet. So in that sense, I think this is a journey. I mean, we all know that banking is very political. So in that sense, I think that the next step would actually be to look into why have there been countries that have not implemented resolution reforms fully. So what I've told you was a bit like the average and the big direction of travel. But of course, there's a lot of differences, like Alexandre mentioned. But I think that what we've seen here is that the new systems have moved banks, the behavior of markets, also the behavior of governments. So I think it's much harder now to say we go to the bailout option if we have done all these other things. So all these reforms have moved the system into the right direction, and in that sense, we've made a lot of progress. You mentioned these cases of individual bank failures, and as you can guess, we had a lot of discussion in the group and with the regulators. So what banks should be on this list and what not. So actually, there's very few cases of this state support that have happened after the reforms have been implemented. And that's interesting because I think these, to some extent, these cases are very idiosyncratic. So we just didn't have that many. We don't have 100 cases to look at, also because of the good macro environment of the past 10 years or so. So there's very few cases which we can actually use to judge whether the new system is working. They're to some extent very idiosyncratic. They also show how hard it is politically, particularly if you have a lot of legacy issues, to really move to the bail-in option. So I think it's interesting to look at these cases. It's interesting, and we've also done a lot of work in the Bundesbank, specifically for Europe, to look at the cases to see whether the European system can be improved. But I wouldn't hold these cases against the overall structure, the overall framework. So I find it much more compelling to look at how all the GSIBs, all the funding structures of all the GSIBs have changed, because that's where you see much more of the action rather than the individual cases that you've mentioned.
In slightly the same vein, I have a question from a semi-anonymously named participant, Andy H. And he's asking, too big to fail is not resolved yet. What about middle-sized banks? Can they leave the market easier without public support? So that's a question to which I would ask. I mean, is it your view that middle-sized banks are more susceptible to being bailed out because they don't have the TLAC, they don't have all these provisions that have been introduced for the large banks thanks to the FSB agenda? Or are they less susceptible to being bailed out just because they're smaller? Or is it, impossible to say? How do you think of this difference between middle-sized banks versus very large banks?
Mm-hmm, mm-hmm. So what we say about resolution is really about, like Alexandra has also explained, is about the resolution reforms that have been put into place. And as you know, there's also in all the different regimes, there's also criteria for size, which banks are covered, what are the criteria to look at also the systemic risk implications of maintaining critical functions. So in that sense, the report says something overall about the resolution regimes. It doesn't say specifically, does this regime deal, how does this specific regime deal with large banks, smaller banks, mid-sized banks? So in that sense, I can't really answer that question specifically because we don't really make that distinction here. I think there's one important lesson from this report and from the work that we've done, which is that this is not just about the globally systemically important banks, it's also about the domestically systemically important banks. And some of the banks that the person who asked the question has in mind might be in that group. And we actually know something about these banks, but we had a very hard time getting the identities, getting information about the policies that are applying to these banks. And I think this is something where we have a role for the international organizations to get a better information base for the DSIBs, but also a lot of homework to be done for the national authorities to be more transparent about who these banks are, how they're treated, what are the policies applying to them. But here I would say this is the whole spectrum of policies, also the capital surcharges, not just the resolution frameworks applied to them.
On this count, there is a fascinating chart in the report that shows that pretty much all jurisdictions have designated domestically important, systemically important banks, so-called DSIBs, except two jurisdictions, which happen to be the two largest, the US and China. So I know that in principle, under FSB rules, you don't comment on individual jurisdictions, but let's take it as not one jurisdiction, but two, which together are systemic globally. Is it a problem that two jurisdictions representing, I don't know, something like 40% or more of the global system don't designate DSIBs?
Yeah, so even though there would be two, but they're so different, these jurisdictions, that if I would comment on any of them, I would still comment on a specific jurisdiction. And my knowledge is just too limited to say anything very specific about these jurisdictions. But what you also see in the report is that, and I mean, just talking in terms of mandate, it wasn't our mandate to look at whether they've done it right or wrong. We just took what they've done and then we worked with that information. But what we've done, and that's interesting, and you can see some of the results in the report. We looked at, we have a group which is called partially treated banks. So they may not be in the group of the GSIBs with clear difference or clear guidance as to the buffers, the additional capital buffers. They may not be in the group of the DSIBs, where again, different across countries, but where DSIB framework applies. But they also are under special supervision and they have to fulfill other capital requirements and regulations. So these banks that you may have in mind might be in that category without us saying anything specific about what these policies are and whether the designation process has been to judge on the designation process.
And I also have an additional question on jurisdictions and designation, which is about the Eurozone. I know there are plenty of internal discussions in the Financial Stability Board, and this is not in your hand, but it's still very striking for me, thinking of the Eurozone as having established a single resolution board, a single resolution mechanism, that the Eurozone doesn't exist in the report. We only look at individual countries. Can you give us a bit of a sense of the assessment here and the trade-offs?
Yeah, so that's right. So we've actually looked at the individual countries. So this report is also not an assessment of the resolution framework in Europe. Maybe that's our homework, not just for each individual country, but we can of course now take the report and say, okay, a lot of things have been flagged in terms of gaps, in terms of information and information sharing. So what are the lessons that we want to take to the European debate? Maybe that's something for the ESRB to take up, or there's different fora also where we can discuss this in Europe. The reason why I think it's interesting to look at the individual countries in Europe, and I don't want to go back to the chart, is you do see that the progress, there's been a lot of progress, and in the end we've all implemented the reforms, but also there's been differences across countries. There's slight differences in how the implementation has progressed in terms of speed. So I think that is interesting, again, for us to understand how effective these reforms in Europe have been. So maybe that's a nice follow-up project for whoever wants to take it up.
But have you considered, if I may, adding a Eurozone jurisdiction in addition to the individual countries? Because, you know, a lot of people are looking at that.
Mm-hmm. Yeah, I would have to go. I mean, we could easily do that. We could group the countries together. So that could be one of the things to do in a follow-up study, to see whether any of the results change. I mean, then that would be an interesting thing, not to see whether any results change if we do that, if we group the countries together. Again, we don't. The purpose of the report is not to say, oh, look, this is what Europe has done right or wrong, but really to get more the big picture. But I should say that all the evidence is there. What we've done in terms of analytics, so it can easily be replicated for Europe.
Interesting. Alexandre, I've left you silent during the last batch of questions, but are there any of these points that you'd like to react to?
No, absolutely. I think, yeah, Europe is certainly one of the trickiest areas in a way to implement resolution, and yet one of the areas where we've seen most of the progress. But it's certainly one element that can still be ironed out is around the speed and effectiveness of the decision-making process. That would be our view. And but then question on resolution of medium-sized banks, I think maybe some of the cases that the person who asked the question had in mind, I think some of these cases don't necessarily speak to what the end state would look like. I think we have to bear in mind that this project started in 2015. So some of the cases we've seen happened just a few years after this, we embarked on this journey. So yes, for now, sometimes I think for investors, it's a bit hard to predict what the behavior would be in some cases, or at least it's been in the past few years. But I don't think that's necessarily something that would presage a certain plan of action in 2-3 years' time, when other things have been ironed out. The decision-making process, for instance, in the Eurozone has been tackled as well, or for instance, buffers have been built by some of these entities.
Another question to you, Alexandre, which is about rating ceilings. That's a standard rating methodology, and in a way it echoes my previous question about the Eurozone. So you told us that you had decided to remove some of the rating uplifts, which is a way of saying governments will pay less if a bank is failing. But traditionally, rating agencies have also applied rating ceilings, which basically means a bank cannot be more creditworthy than the country in which it's established. So both generally, globally, and in the special case of the Eurozone, can you give us an update on how you're thinking in terms of rating ceilings for banks?
Sure, no, absolutely. You're perfectly right that I'll use the word typically. It's a very important word, typically. We think it's rare for the creditworthiness of a bank to be higher than that of its main country of operation. That said, there are a few exceptions, sometimes few exceptions, especially for banks that would be extremely diversified. What we do in those cases is we do a stress test and take some really severe assumptions of what type of stress that bank would have to be exposed to in the event of a sovereign stress test. And we see if we believe that the bank could pass that test. And in this case, we could rate a bank, for instance, 1, or maybe some really rare cases, 2 notches above, for instance, the sovereign ceiling. In the cases of ALAC as well, we take ALAC into consideration in terms of the ability to absorb a sovereign stress test. So in some cases as well, on basis of these ALAC buffers, we can have a issuer credit rating that's slightly higher than the sovereign. But by and large, you're right. These cases where rates above the sovereign are relatively large, and the notch differential would be very limited.
What about the Eurozone? I mean, there's a large bank in a Eurozone country which has plenty of problems, but the bank has a lot of operations outside. How do you think about ceiling in the specific case of the Eurozone where so many things are, special?
Yeah, we still attach a bank to countries as opposed to the Eurozone for now. So if we assume a large Eurozone bank that's very diversified in lots of countries, we don't consider a Eurozone ceiling as such, but we would look at, for instance, what would a sovereign default of their home jurisdiction or some other large countries they're exposed to, what would that mean? If they can pass, for instance, the stress we associate with a sovereign defaults of the country, for instance, where they are domiciled, we could rate that entity above that country, but we don't necessarily consider the Eurozone as itself as a ceiling. But for the purpose of, for instance, ALAC and being able, considering those ALAC buffers to rate the entity above its country of domicile, I'd say the fact it's part of the Eurozone in general does play a role because it will have a bearing on our assessment, for instance, of the liquidity that might be still available to it or other support mechanisms that could happen coming from outside the country of domicile. But the analysis still start on the country of domicile.
What would it take in terms of legislative reforms and completing the banking union for you to abandon this country-by-country approach in the Eurozone?
It's an excellent question. I think it will still, I mean, it's something that I'm not saying never. I think we've learned to never say never, especially the working financial market for 20 years. But there needs to be more, well, who makes the decision? Is there a smooth, predictable, central decision-making process? Legal framework? Do you have a homogeneous, for instance, liquidation or insolvency framework? And is there a mutualization of some of these support mechanisms or funds across that? What is the nature of the deposit guarantee scheme? Is it again a homogeneous pan-Eurozone? So it is possible, but we would need to see that there is probably a utilization of some of these risk-sharing mechanism and a very efficient decision-making process.
That's extremely interesting, and I think some things that policymakers should listen to in terms of the ongoing debates about completing the banking union. Any comments from you, Claudia, on that?
Well, it was a very good explanation of why we're not treating the euro area as a country. So yeah, it's not that we had the discussion in much detail, but yeah, no, I fully agree. And also a lot of, I mean, this is, I think, something that's sometimes overlooked when we think about this in a little bit bigger policy space about financial stability. So financial stability is also, I mean, it's coordinated at the European level. I mentioned the European Systemic Risk Board. We have the Financial Stability Committee at the ECB, but a lot of the power, a lot of the decision-making, a lot of the analytical work rests at the national level. So it's really, I think, balanced it out very nicely in Europe. So there's still a strong role also of the national authorities for the reason that Alexandre has mentioned.
So I have a number of questions about this theme of financial stability, and let's take a few of them. So for example, Michael P. on Slido is asking, how about systemic crisis? Will the BRRD framework be used in case of systemic crisis? That's obviously a question specifically for the European Union. Is contagion risk of bail-inable debt a problem between European banks? But I think beyond the European Union, there's a general question about whether the resolution framework, as it has been introduced under FSB principles, really can be used beyond idiosyncratic shocks, and whether, if people have in mind what happened in the US in 2008, the Tim Geithner doctrine, and basically when there is doubt that extends to the entire system and not just one bank, can you really believe that TLAC will be bailed in and that things will move according to plan, when we actually see in your Annex G that this isn't even happening in cases of idiosyncratic problems of medium-sized banks so far? So is there really a reason to believe that in a systemic crisis situation, this framework has predictive power? Claudia?
Yeah, so excellent question. And obviously, I mean, it hasn't been framed in the context of the COVID pandemic, but it's obviously a question that also comes out in the current circumstances, although maybe we come back to that in a second. I would like to give the more general answer, and then we can talk about the current situation. So the more general answer is that I think my thinking about what's the effectiveness of this framework for systemic risk and for systemic crisis starts actually with a going concern, starts with how does the framework contribute to reducing the probability of the crisis and the capital shortfall in a crisis. So that was a bit in the chart that I showed at the beginning. And what we're seeing is that, yes, all the indicators are moving into the right direction. So we see less systemic risk. Obviously, what we measure here is based on market indicators. It's based on a period prior to the COVID pandemic. But just if you go through all these things, then you see that, if anything, this has contributed to reducing systemic risk. But we also know that, we don't reduce the probability to zero, like with none of the regulations. We want to entirely eliminate crisis. So we can't rule out that we run into a situation where authorities have to judge, well, if they do bail-in, if they deal with distressed banks, that this has financial stability repercussions. And I think that's where also the frameworks that we're looking at do give some flexibility. So it's not that, again, it's not a 0-1 world. It's just it's about reducing probabilities, reducing capital shortfall. Once we get into a situation that we haven't foreseen, there needs to be some flexibility. Again, the report wouldn't say anything about what specific authorities have to do. So that's always going to be a judgment that the authorities have to take. And if anything, the system has moved them more towards the bail-in versus the bailout option.
Yeah, but I mean, I guess many of our audience are asking, the system was almost entirely bailout. We're still seeing almost systematic bailout in cases of idiosyncratic bank problems. So it may have moved incrementally in the direction of bail-in, but that's still very far from bail-in being the baseline scenario, right? So specifically in the context of COVID-19, very bluntly, the last question that was asked on Slido, is it possible to imagine any resolution during the COVID-19 period, or is it just something that simply won't happen? What do you think?
Just one sentence going back to the pre-COVID, and then I come to your question. Well, the period that we're looking at here, so the period over which we do the evaluation, has of course also been a period with a very benign macro environment. So again, we've discussed these cases that have happened, and nobody's really happy about them. But I think we need to take that into consideration, that the stress test for the system we haven't really seen yet. So, and there's lots that can be said about these individual cases. Now, coming to the COVID experience. So first of all, the shock that has hit the global economy is really unprecedented. I think it's also a shock for which we can't prepare. There's no insurance that would insure you into a global shock of that against a global shock of that dimension. So what we have seen is really to protect the real economy, to protect the financial system, is these massive policy measures that have been taken, both fiscal, monetary, and also the regulatory relief, the temporary regulatory relief, we should say, has also contributed its share. So, this is basically taking these strong policy responses plus the better capitalization of the banks going into the crisis has certainly done a very important job to protect the stability of the system. Does any of us know what's happening next? Does any of us know how the crisis will evolve and what measures are needed? No. So we basically said, well, what we can say here with this report about the crisis without having done any analytical work here is to say, yes, the system went into the crisis being more robust. That alone is certainly not enough, but it needs all these accompanying policy measures that are now also being analyzed. And what we can say is that whatever happens in individual countries, individual systems, the authorities have now more options to deal with these cases that happen. I think that's a pretty strong message that these options are there. How they're being used, what are the circumstances? I'm not able to forecast and make any statements. I think none of us can actually.
Well, there are a number of questions on Slido about individual jurisdictions, for example, about the US, about how the report should say more things about individual jurisdictions. And I'm not going to relay those because I know what your answer will be, which is a report is not about individual jurisdictions, and that's how the FSB works. So my apologies for those in the audience who asked those questions, but I encourage everybody actually to respond to the consultation. And indeed, there is, for example, one note on Slido saying, the final report drew more distinctions between jurisdictions' progress, e.g. US versus China. This is important for investors. So that feedback to the authors, to the report authors, and I encourage you to do it at FSB at fsb.org, as Claudia reminded us. And by the way, if you're worried about hearing fighter planes making noise in my background, this is because I'm in Paris and there is some rehearsal before the 14th of July, but it's not World War III. There is a question, however, that I will relay, which is about the current circumstances of Europe in the context of COVID-19. So Ian Bay is asking, TBTF seen some political fracture between EU states as part of the COVID-19 reaction. Does this concern you regarding the political alignment to really test too big to fail? So maybe a word on this. Also, Alexandre, but Claudia first.
Sorry, I was a little bit distracted because I heard also some noises in the back. Can you repeat the question? Or Alexandre started and I heard parts of it and I tried.
Yeah, sorry about the fighter jets. So the question is about political fractures linked to the COVID-19 reaction between EU member states, and whether this concerns you regarding the political alignment to really test too big to fail. That's the way the question was worded, which is really, so basically political fractures linked to what you're observing. And of course, I'm asking you that question, not just as an FSB representative, but a little bit about your Bundesbank capacity.
Okay. So let me, first two things, because you mentioned all the questions that are coming in on individual countries. Yes, like Nicolas said, give feedback to the FSB, and the feedback, this is a long report, it's a long technical appendix, so the feedback doesn't have to cover all the ground, but you can focus on the questions that are most interesting to you. Send us evidence that we should consider, so we will take all that on board. So it's not like we're not taking evidence on individual countries, so we also have some country studies actually in the background, but we wouldn't make any policy statements. But we're also very transparent about the resolution reforms, how countries have progressed. I've shown you some of this. On your broader question about the, I would say the political lessons that are drawn from the crisis, clearly, here I'm not speaking as the chair of this group, but in my own capacity. So I think generally, of course, times are extremely difficult, and we all don't know how things are going to evolve. But I'm actually quite happy about the policy response that we're seeing in Europe right now. So we've recently issued also a small opinion piece with my colleagues Sylvie Goulart and Federico Signorini from Banca d'Italia and Banque de France, where we're saying that, of course, a lot of decisions that have to be taken now are beyond the mandate of central banks. So first and foremost, we're dealing with health issues, and this is far away from central bank mandates. But there's a lot of important reasons why we need coordinated policy responses. And what I'm seeing so far is, of course, we do have a lot of discussions, but I'm seeing also that there's a lot of will to come together and find common solutions. And I think that is very important for Europe. But here I'm talking more about it as a European citizen rather than as a chair of this group, and maybe not even a Bundesbank vice president. Thanks.
Alexandre, on this?
No, I would just add, I would echo some of the comments made by Claudia. Political alignment, whenever we talk of Europe, is often a topic. So yes, obviously political alignments in this context always something we look at, but I wouldn't say particularly in the context of COVID-19. COVID-19 is, as Claudia said, unprecedented, and also it's a shock that's exogenous. It comes from outside the banking system. They're not the culprits. If anything, at the moment they are helping with the crisis. So the statements made by the European Commission on stated rules, the fact there could be a loosening of some of these rules, is not something that would concern us. It is an exceptional crisis, and too big to fail, all those resolution regimes are here to give optionality. And then, depending on the type of crisis, the authorities will choose the most appropriate option. So in terms of ratings, despite the comments made or statements made by the European Commission, we have not changed our assessment of the supportiveness of the EU countries. We still put support on certain. Again, that doesn't mean that there wouldn't be any support available potentially in a scenario like that, but it's just at the moment, it's not our base case, and it's not our base case for the longer term.
There's another question specifically to you, Alexandre, which I find interesting from Kalle P. Has TLAC reduced systemic risk at all, or even increased systemic risk due to the allocation? And you mentioned data gaps in terms of who holds TLAC, but could you answer that question in a kind of holistic way?
Well, the holistic way, and I love this question holistically, is that, yeah, I mean, too big to fail, what you can do is obviously reduce the cost of the crisis. But if you have a crisis, whether it's a bailout or a bail-in, you have the same amount of losses in a way that are absorbed by someone. And guess what? Those someone always end up being people. So it's just, is it people via as taxpayers or as investors in pension funds, insurance products, etc. So again, I think TLAC is a way to give optionality and a way to spread these losses among people who can bear them. But yes, I think that's one of the data gaps that could be bridged and would be interesting to see bridged. And I know that in European context, there has been some progress is to see who holds this TLAC and almost do stress tests. What would happen if you had a big GSIB in the region going bust, bailing of these instruments? What would it mean for our pension funds or insurance companies, etc.? At the moment, I'm not saying I'm overly worried by that. I believe that people independently take the right risk management initiatives to avoid over excessive concentration. But yes, ultimately, losses are absorbed by someone, and there are always people behind those losses who are absorbing that.
And obviously, I love your semantics because you always talk about optionality. Isn't that a way of saying that too big to fail will never be ended if we still have optionality?
I think for me, the too big to fail is a great catchphrase, but I prefer almost the FSB chair's phrase around what was the expression, global in life, talking of banks that are global in life and orderly in death. Probably the best catchphrase for me would be the orderly in death, although it might be a bit macabre, so too big to fail is probably more appropriate. But that's what we're aiming to do, just make sure that the ramification of a failure are as limited as possible, as more controllable. Whether it's too big to fail, and if one day the preferred option is still bailout, that's fine, but at least people won't have been cornered into doing that. It will be because this has been the better option.
Credit where credit is due. This quip about banks being international in death and international in life and national in death, I think was first formulated by Tom Huertas when he was at the Financial Services Authority in the UK. To you, Claudia, I mean, that same question. Has TLAC reduced systemic risk at all or even increased it due to the allocation? Is there an answer to that question in the report?
Yeah, so well, one word first about this optionality. I think this is not just about the choice between bail-in and bail-out, but there's many other resolution tools that can be used. So that's part of the optionality. That is available now. Yes, I mean, in the end, if there's a loss, and I mean, one objective again is to minimize the losses and to minimize the systemic risk, but losses can never be avoided. So if there's a loss, somebody has to bear it. I think the big differences between TLAC investors and the taxpayer is that the TLAC investors, they also now they get a premium, they get a risk premium for their investments, and the taxpayer was quite innocent. He or she didn't even know that they were standing in for this bank. So I think that's the big difference. So we have now a group of investors who hopefully know what they are doing. They get in the going concern. They get a nice return for their investments, and so they should have the capacity also to bear these risks and to bear these losses. And I think that's where the report, and again, this is data we have for Europe for those who are familiar with the statistics. We have the securities holdings database in Europe where we can actually trace the TLAC investors. We have that.
There's a question about that, the detail of what you called good data infrastructure regarding TLAC in Europe. Where is that to be found?
Well, that's data by that's collected in the European the ECB system, so the European Central Banking System. So the ECB does this. The Bundesbank statistics also does this.
Is it public data or is it only available to supervisors?
It's highly confidential, obviously, but it should be available also through our research data center. So we make this, I mean, it's published in aggregate form, but the individual, it's very granular data, so that's highly confidential. So we also make it as accessible for researchers, and it has been used for a lot of research studies. So we do have that information in Europe. An interesting piece of information, perhaps, when you look at the report, you find that most of the TLAC holdings of the GSIBs are not in the retail sector. So that's good news, because that means, again, those who have invested hopefully know what they're doing. So that's a bit different to some extent in some European countries still. So that's legacy issues. And also another thing that's important is that not too much of this is held within the banking sector. So, and there we have different rules in Europe and globally. So in Europe, we have still much more intra-sectoral holdings. So when you look at the Bundesbank Financial Stability Report, you will see that in Germany, we have a lot of this bail-in debt being held within the banking sector. And that, of course, is an issue about diversification. So I think that's what I meant. So I think all countries should now take the report and go through it and see what their homework is in terms of improving their own system.
Well, maybe many of you have viewed the Hamilton video now that it's streaming and accessible. And there's this refrain in the Hamilton musical, there's a million things I haven't done. Here, there's a million questions we haven't asked and answered, but our time is up. This is a discussion to be continued. Obviously, the consultation is ongoing, so everybody's encouraged to respond to it directly, because I think that's public service. It's really a big issue for public policy, not just in Europe, and a big project of the Financial Stability Board. And also we at Bruegel obviously will continue to have a lot of debates about this issue and related issues that are specific to the European Union and the neighboring countries, including the UK, Switzerland, in the near future. So many thanks to our two guests today, Claudia Burch of the Financial Stability Board, and of course on a permanent basis of the Bundesbank, Alexandre Biry of S&P Global. Have a very good rest of your day, and we look forward to future conversations at Bruegel. Many thanks.
Thanks for having us.